All right, the S&P 500 continued to streak, now up to 8 days and 9 days on the NASDAQ 100. Those aren't unprecedented streaks. We've seen some of these streaks before. During this 8-day run, the S&P has had a pretty good return. Same thing with the NASDAQ over that 9-day run. Those aren't unprecedented, and I'm going to show you some other instances of when those have happened in the past and how that impacts our expectations going forward for the market. Why we've rallied so much in such a short amount of time, whether that is able to persist going forward, and that will also impact our expectations for the market. We'll take a look at what's driving this price action. Very significant changes over the past 3 days compared to last week. We'll break those differences down, what they mean. And of course, our trade idea is a stock that's been a nice little move itself. We'll talk about how to take advantage of the range that it's in. So let's go ahead and get started. Today is Wednesday, November the 8th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. If you're watching on our blog here, check out some of these other things over here on the right, including our Market Outlook live video. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on these platforms. That's why we always ask for it day in and day out. Thank you to those who do click this every day. Those who don't, you can do it right now while you're watching with 1 or 2 really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we continued the rally here. This is, 8 days in a row to the upside. Obviously, the last few days have been small gains and small ranges. That continues to be a theme. Right around the low 30s the last 2 days. The average, remember, is in the low 50s, so we're well below the average. The intermediate line, though, has made its way well into the reversal zone. Now it's up close to the 90th percentile. The near-term line is also still in the reversal zone. So despite the momentum line not having gotten up there and having dropped down to briefly into oversold levels, it actually has bounced back up too. But still sitting right around the midpoint. Again, it's hard for the near-term line to make such a strong move without the momentum line preceding it. As you can see kind of like here, and you can see the last time it kind of had a failure right there. So ideally, you want the momentum line to get at least above the 80th percentile before the near-term line does. And obviously that was not the case this go around, mainly because of these gaps that we had, these opening gaps that we had for most of last week on Monday and then on Thursday and again on Friday. But you can see we're still right around that 2.25% mark above the moving average. We're still kind of flirting with these old high points over here. I think this is actually a higher close than any of these. The highest close over here we had at 43.73. This one's at 43.76, almost 77. We're at 43.82. So this is a higher close. In fact, yesterday's close was barely the higher close. But again, you notice we're not with such a strong move. It's going to be hard to sustain that kind of a rally. Especially, like I said, having 8 days in a row to the upside. Not common to have 8 straight days. Pretty common to have Monday being the high point, but we've just kind of gone sideways since that nice little Monday gain. A little bit of an upward move yesterday. That's not the case on the Russell 2000. The Russell 2000, you can see, is actually back down below its falling moving average. The intermediate line is still rising, so you got the dark green shading. It's above 50, that's why it's dark green. But you see, as it's because it's between 20 and 50 or 20 and 80 while it's rising, then when the near-term line crosses below it, that's a bearish crossover, and so that's what we've got. Is the near-term line has made its way down to where the momentum line is, and for that matter, where market sentiment is, down in oversold levels. So that's a bearish drop. So you can see after getting the bear tag last Friday, and a pretty decent one too, over 2% above the 30-day moving average, we weren't able to sustain that. In fact, we not only have not able to sustain it, but we've gone back down below the moving average, and the near-term line has crossed back down below the intermediate line. So much different scenario on the Russell than what we're seeing on the large cap index. In fact, when you look at the Dow Jones Industrial Average, I mean, it looks very similar to the S&P. The near-term line's a little bit lower. It's out of the reversal zone. It's a little bit more bearish, but it's still kind of, I mean, the intermediate line's above the 90th percentile. If you look at the Dow Jones Transportation Average, it's a little bit of a different story, right? It's very similar to what we're seeing on the Russell 2000. So we're not quite getting that confirmation of both those Dow Jones averages that you like to see from the old school Dow theory. There. The NASDAQ 100, which again is like 50% of the Magnificent Seven. It is also above those previous highs. The intermediate line's also up in the reversal zone. Market sentiment still in bearish territory, though it's rising. We ended up getting about 3% over. So it's still a pretty bullish pattern from that perspective, though. You can see the last so many days. And it's also been up, 8 days in a row here. Let's go to the daily price moves. Yeah, you got 1, 2, 3, 4, 5, 6, 7, 8 days in a row on the NASDAQ. Oh, excuse me, that's the S&P. Let's go to the NASDAQ 100. 1, 2, 3, 4, 9 days in a row now on the NASDAQ 100. So still quite the streak. And again, most of these days, all except for, even that day is barely a gap up to the upside. But every single one of these days have also included a gap to the upside. So it kind of goes to show the bullish personality in the markets here. At least the market's trying to be bullish. Very strong weekly candle on the S&P 500. In fact, one of your bigger weekly candles that we've seen in a while. So we had the reversal. It's a close. It's a higher high point. It's a close, higher close. Very strongly bullish, obviously above the moving average. 10-week exponential moving average that is now rising. So the PPO, before getting the zero, starting to rise again. That's actually a really good bullish reversal pattern. You look at the 3 green arrows. We obviously have 3 green arrows now for 5 days. So we've had 5 days of 3 green arrows on the S&P. We do not have 3 green arrows anymore on the Russell. So we only had 3 days, and it's already gone back to red. You can see the histogram is declining on the S&P. It's also declining on the diamonds, as the diamonds are actually ended up finishing lower today. Not quite as low as Russell, which is down 1%, but ended up finishing lower there. Now some of these other oscillators aren't quite as bullish, right? You've got the DMI, where the positive indicator is flirting with getting above 30, but the negative is not dropped below 20 yet. Still easily above 20, so not getting the combination we'd like to see there. The RSI and the CCI are also still kind of at bearish peak levels, right up against 60, like we were over here. Barely above 100, not quite above the 150 mark like we had the last couple of peaks. So not quite getting the bearish breakout down there on these oscillators either to support this move. Looking at the Ichimoku cloud, we are in the cloud. We're not through to the other end of the cloud yet. The green line's not crossed that blue line yet. And you can see we don't have a trend developed here, not even a bullish trend. And if, again, you look back at IWM did lose its bearish trend, but you can see it's almost back. The rate of change is still negative, and you're almost back down below that blue and green lines for that matter. And so you see the dichotomy here. It's still a very weak Russell 2000, whereas the Qs especially is trying to keep the S&P afloat, right? The Qs are above its cloud. The green line looks like it's slightly crossing the blue, and you do have the inklings of a new weak bullish trend developing here with the positive rate of change. So you see this Magnificent Seven really trying hard to keep the markets going. You can see we did not get a new high point. We came within a whisker of getting it. The diamonds did get a new 4-week high point today. You see that over there, and so did the Qs. Getting a new high point. IWM, of course, did not get a new high point. Filled in Thursday's gap now, and now is flirting with dropping into lower half of the chart and potentially filling in, Friday's gap. If we drop below the chart's midpoint, would be in danger of filling in the Thursday gap. So if the small cap index is suggesting that we're going to fill in this gap here from Friday, then we might not get that high point. You can see we aren't quite set up to get it yet. We did drop below 70 on the red line. We haven't gotten to 0 yet on the green line. But you can see how close we are. In fact, we close less than $1 away from getting a new high. So we'll be right there. The last thing we want to see, though, is if we were to get a one touch, right? So if the Qs just kind of get a one touch here and then fails, we actually had a two touch over there. But if that's all we get and we don't get any more new highs, then that would be just as bearish as if we just held resistance, or probably more bearish as if we just held resistance. A lot of people see these 4-week breakouts as good breakout candidates. So that wouldn't be the best sign there. And then you can see also these last few days moves have all been really low volume, very small ranges. That's actually bringing this chart down, which is not a bad thing. It's kind of good for the ATR and the volume to be dropping. It'd be ideal if it didn't drop so fast, because you want the money flow, which the index oscillator's gotten into that sucker zone between 50 and 60. But the actual summation index still hasn't exceeded the price. This peak from over here in mid-October, and we've easily exceeded that on the price index itself. So we're still not getting the confirmation of the money flow, which the indication, despite 8 days of rallying, which because it's a summation, you're going to add every single day to the upside. So despite that, we're not getting that. If you look at the Bollinger Bands and the Keltner channels here, you can see again we're up to the upper quartile of bandwidth. We're not, and we're up against the Keltner channel, but we're not above the Keltner channel, and we're not in the upper quartile of the bandwidth. So it's great momentum here. We had a little jump in momentum. We were bearish, now we're bullish, but we're not getting enough momentum enough to really expand out this bandwidth, right? That's already at relatively high levels. And you're right up against this top of the value area. You're right up against this one little volume node that we have up in this zone. So again, you kind of get a picture of why we're slowing down. We spent so much energy to get to this point. It wasn't a breakout move. It was kind of a reconciling or consolidating an oversold move to the downside, but it's not changing the trend of that oversold move. And you can see volatility continues to be extremely low, almost to the 85th percentile, but easily below 15. But you can see over the past few days, the VVIX has been rising while the VIX has been continuing lower. So it hasn't impacted this 10-day correlation yet, but again, you expect that it would as we get more and more of that divergence there. And when the correlation does drop below 50, that sets you up for a move where both the VVIX and the VIX rise back up again. And we know what kind of condition that puts for the markets. Generally is more of a bearish condition for the markets. So it's been a good rally. It hasn't been, it's because we front loaded a lot of the rally in the first few days. The past few days have been really weak, and the volume has been really tapering off. So that's setting us up for, kind of suggesting that maybe this move wasn't nearly as bullish from a technical standpoint, and that we're set up to have a little bit of a decline here. I tweeted out the 8-day returns of going into today for the NASDAQ 100. Obviously, that was the winning streak that the NASDAQ 100 was on. It's a really, really high level for the NASDAQ, and we've seen this before. Again, we generally see this coming off of correction lows when monetary policy is pretty accommodative, like in 2020 off the COVID lows, and then 2018 correction low point where we were down on the 200-week moving average. The Fed changed their policies there at the beginning of 19. They dropped to the 0% interest rates in 2020. But this is more like the 2022 situation where the Fed is still pretty restrictive, right? I mean, they're not raising rates anymore. They haven't raised rates since July 26, and yet the market's been, afraid of rate hikes. But the market is anticipating the Fed to be cutting rates, and maybe that's one of the reasons why, but that's obviously not going to be the case. So you would think that this 8% move is more like some of these others, and you notice a lot of these others started, big move up and got your 8% plus move, and then we declined. And same thing over here, and then same thing here, even if it was just to a, pretty much an equal low point there. And these are all 8-day returns too. This is a rolling 8-day window, but you can see the rolling 8-day window rolls into a negative 8-day return from these strong high levels. And again, right around that 5, 6, 7% mark. So it looks like that's potentially where we're heading right now, and why another reason why I'm not necessarily as gung-ho as a lot of these traders have been over the past week. All right, now let's take a look at what's driving this price action. You can see one of the bigger reasons why the rally's been going on is this rally in bonds. Bonds really taking off to the upside, really helping fuel a lot of this move. You can see when it ended for the Russell 2000 and for commodities. You can see the dollar has been strong for the past 3 months, continues to remain strong here. Let's just look at today. Again, kind of this, we can just even look at this last few days. But let's start off with today first. And you can see it really wasn't much of a move except for in bonds. So bonds really rallied up. And again, like I said, that's been having a big impact on stocks previously, not today. As you can see, the stocks were flat at best, and IWM is actually down 1%. Of course, if you were to go, just a reminder here, last week, again, the big move up in bonds helped fuel a lot of it. IWM, VNQ, QQQ, this big move higher in bonds really fueled a lot of that as well, as yields were falling, right? When bonds rally, yields fall. Really moved up higher. But now you saw today, and if I were to fast forward to the last 3 days here, you can see that, again, bonds are up 2.2% for the week. They started the week down, and stocks were still flat. And then they rallied yesterday, and the Qs rallied yesterday. But I mean, IWM's down 2.6% this week, and bonds are up 2%. So dramatic difference from what we saw last week with the rise in bonds. Commodities really getting hit hard this week, so that's a big difference. High yield is still kind of lagging behind. In fact, when you look at the ratio chart here of high yield, relative, not to TLT because that's too long term, but if you look at it relative to IEI here, and let's just make sure I have it on the daily chart, the 1-year chart, there we go. So if you look at how high yield's been doing there after a big run up last week, the last 3 days really dropping back off. Again, strong correlation with the market, so it's rallying up strongly, but dropping to the downside. As you can see, it looks like the MACD is peaking. You see the rate of change there. In fact, we don't need the rate of change anymore, so I'll just close that out here. There we go. But what really kind of the big ratio stood out to me so far this week, because of the weakness in IWM, is what we're seeing here in the ratio of the Qs to IWM. You see we closed right at 2.195. So we've only closed above 2.2 twice in the history of this ratio. And that was August 31st of 2000 and September 1st of 2000. So 2 back-to-back days were the only 2 days. And from that point on, that September 2000 was when the bear market started, as it started to falter. So I mean, you could argue right now the Qs are as overbought against the small cap index now as it was in the tech bubble and the highest peak of the tech bubble. So, and I saw some tweets out there talking about the about 14% or almost 14.5% combined between Apple and Microsoft being up in the S&P 500, making up 14.5% of the S&P. That being the biggest number for the two stocks that we've seen in a long time, like decades and decades. So needless to say, the market is strongly overbought. The Qs are strongly overbought relative. And again, as this correlation turns back, if you look at the weekly version of this chart, the correlation's strongly positive, 75th percentile. and pretty much maintains a pretty strong positive trend for the most part on a long-term basis, especially here lately in 2022 on. But for the most part, it maintains a positive trend. You can see the weekly chart, just how overbought we are on a long-term basis. The PPO is at very high levels. The CCI is high. The RSI is high. But then going back to the daily chart down here, again, the correlation is not typically negative. So the correlation is returning back to being positive. The question is, will this ratio keep going up? Considering it's pretty much at, I mean, literally historic highs for this ratio. Has really gone up since the beginning of August. Remember the correction that we've had started on August 31st. So since this correction, since we've been bearish, this ratio has just continued higher. That's why the correlation's dropped down to negative levels. Now it's like, okay, now that it's been so negative, and it's been a while since it's been so negative. You have to go back. For this long especially, you have to go back to the reopening trade where the ratio dropped and the S&P 500 rallied. So this is a little different this time because the ratio is rallying while the S&P 500 dropped. So that was kind of similar to coming off of the COVID when the economy was shut down. But there's no banking crisis right now, which impacted the Russell 2000 earlier this year in March. This little dip right here. There's no reopening. There's no economic shutdown. All these factors that impacted or impaired the Russell 2000 to the point where this correlation ended up being negative as the markets rallied. So, if that's the case, if the correlation is turning back to being positive, and you wonder, okay, we're pretty, long-term PPO is high. All these oscillators like the CCI is back above 200. We're coming off of a level above 70. I mean, there's very strong moves in this ratio. The likelihood of it staying up here, especially considered as you saw how strong a 3-day move this is, more than likely this is going to end up kind of being kind of an exhaustion type move to the upside. And as the correlation rallies back to 0 and back to 50 to 75%, that will most likely start to fill in this gap between 50 and 200-day moving averages. That's the expectation, and you'll start to see, even if bonds were to rally, you'll start to see the Qs start to come back down in this area. High yields start, underperforming IEI, not so much TLT, but at least IEI. And more than likely, the question is, and the reason why we've been so bullish is the 10-year yield has dropped down to its 50-day moving average, a little bit below it today, still inside the range from last Friday, with a very strong negative PPO here, and then of course the stochastic. So now it's like, okay, will we hit this 50% retracement and bounce back up above the 50 and get back above and just be a pullback, or will we will we start to work our way down towards 4%, towards the bottom, back to where this whole thing started back over here? And again, the likelihood of this dropping back down to 4%, even with a soft inflation number, is not very likely, right? Considering again the deficit spending we have and everything that caused this rally to begin with. Like, this rally didn't take off because of inflation going higher. If you look at like crude oil as a rough proxy for inflation expectations, crude oil peaked over here on September 27th. So when you look at the 10-year yield, September 27th is right here. So you can see we actually continue to go higher even after crude oil peaked and started to really come off to the downside. So it's not necessarily, this inflation softening story. It's actually more of a rate cut story, right? The odds of a rate cut continuing to move higher going into that June meeting. We had moved up. At one point in time, we had 86% odds of a rate hike. You're getting, or 14% odds of no rate hike. Right now, we're at about 27% odds of no rate hike. So still, even though it's ramped back up from 14, it's still a very low number, not nearly as high as it was a while ago when it was, up to around 60% odds of no rate hike. So that's what the market's pricing in, and the problem is that spending hasn't changed and the Fed's policy hasn't changed. They might be done raising, and the market hasn't had any indications. Like you can see, the rate hike odds for December contract were never above 60%. So the market hasn't been pricing in a rate cut ever, and that was the same thing for November too. The odds of a rate hike for November only got above 60% for like a day here and a couple of days over here. So I mean the last rate hike, here we had we got up to this 5.25%, 5.5%. Was kind of the case over here in July, that July meeting, getting up and stayed there in September as well, going into the September meeting. No rate hike odds there. They were above 60% and above 80% for a couple of days right before the banking crisis, and we never did get again. So the market wasn't looking for a rate hike in September and November. Same thing, 5.5 to 5.75, or in December. So that hasn't changed, right? We're not looking for it in January. It's even a smaller number in January, still kind of in that 30% range. In March, you can see this is the odds of a rate hike for March of next year. And then now getting to May, it's just continuing to drop lower and lower. Here it is down. This is the odds of rate hike for next June. So, and it never has been above 100 and has only barely been above 20 for a few days. So that's the narrative, is that the market is anticipating the Fed to start cutting rates by next June. High probability of them cutting rates by next June. And as you can see from like the bond market doesn't believe it. The futures market thinks so. The bond market doesn't believe it. As you can see, the 3-month hasn't been dropping. The 2-year has dropped a little bit, but still is kind of right around that 5% mark. Hasn't really dropped significantly. So the bond market's not necessarily buying that idea of rate cuts, at least on the short end. But the stock market is definitely buying that idea. And the question is whether or not this will continue lower as the market continues to price. I mean, if we got to 4%, I mean, you're going to have pretty near 100% odds of a rate cut by like next May, if not next March. So, is that likely? I don't think so, but that's kind of the move that's necessary for the markets the stock market, at least apparently from what we've seen, to be bullish, to maintain its bullish trend right now. Let's take a look at the sector moves and how they did here. So bear with me 1 second while I bring in the sector comparison chart. And you can see, of course, here, let's look at this past. Let's look at last week as a reminder of what happened last week first. There we go. So again, you can see the big move higher in real estate. Financials did very well, but XLK, XLY, XLC, I mean, there's your big gainers, and that's not surprising. It pretty much makes up the Qs. But going into this week, again, with bonds doing very well, you would think we'd have a very similar reaction here to some of the sectors. Communication services lagging behind. Technology is up 2%. Discretionary not really matching that, about half the returns, and energy just getting hammered. Energy materials especially just getting hammered again, as you saw, the Russell 2000 is down to over 2%, and a lot of these indexes are more correlated with that. Even real estate and utilities are down, with yields being down. They're both struggling there, and you would think that they would benefit from the fallen yields, but they really haven't. So you see you kind of see what's driving this, and a lot of it, and going back to the beginning of last week here, a lot of it is that strength in that tech sector, up 8-9% on XLK and XLY, and it's showing up here in the 12 grid as well. You can see all that strength across the top three sectors up here, XLK, XLY, XLC, looking very strong. Look at XLK blowing up above its moving average. XLY and XLC, not so much, but coming off of, probably deeper low points there, and you got dark green shading in the green line. Financials is looking halfway decent there. But look at energy, it's like producing an oversold cluster right now. And we're dark green shading across the board, but we're not really dark green shading a green line in most places, not like you're seeing, especially in the technology sector. So you wonder, it's like, okay, 1, 2, 3, 4, 5, 6, 7, 8, 9 days in a row for XLK to the upside. If I were to take a look at the rate of change for XLK and do it over 90, we shoot even over 26 days at a pretty decent number. But if you look at it over the past 9 days, and again, this would be Apple and Microsoft, and you're up almost 10%. Again, we had that before. It's not common. Here, let's go 5 years. We've been close to 12% multiple times, but you notice all those moves of nearly 10% occurred during 2022 during the correction. And they all pretty much ended the rallies that we had there. The rally that we had here, 9.67. In May, the rally that we had here at just over 10% lasted a little bit longer before diverging right before Jackson Hole to the downside. All these moves you can see pretty much produced 9% declines to the downside. Even this one over here produced a 9% 9-day return to the downside. Again, I talked about that with my tweet, that when you get these big returns to the upside, almost 9% there, you typically follow suit with an eventual 9-day return of, in this case, we were down, we got down to 7% over a 9-day return to the downside. So anytime you get these big moves, they typically follow up with a 9-day return. So that's roughly 2 weeks return to the downside, and that's kind of the expectation we're looking for right now, going into not necessarily like the next 9-day window, but over the course of the next week or two, you'll probably end up pushing down to the downside towards that 5% mark for this particular time frame. All right, let's take a look at our trade idea of the day, and we'll take a look at Costco. Costco's been on a sideways trend for the past few months, kind of at the upper end of that trend. We got dark green shading and a green line, but the near-term line looks poised to drop below the intermediate line, just as the intermediate line is crossing above market sentiment. So kind of a neutral standpoint from that perspective. You can see from a 3 green arrow perspective here, we are above the moving average. MACD is positive, stochastic's positive, but MACD histogram is already rolling over. You're getting a little bit of a reversal pattern here as we head back towards this volume node. If you look at the weekly chart, you can see that kind of all these transition candles we've been getting around this area. We had been bearish. We turned with the red arrow. We turned right back around with a green arrow, slight bullish candle, but really small candles. Nothing that's like, that suggests that we're kind of breaking out to a trend. Both the positive and negative indicators on the DMI are below 25. The ADX is falling down there below 16 or below 20. Looking at the CCI and the RSI, they appear to be peaking at these levels like we've seen here previously. So looking like we might be ranging back towards the bottom end of this range. And finally, looking at the Bollinger Bands here, the band width is relatively high and starting to roll over as we're not in the upper quartile, closer to the middle, and then very little momentum. Bands are outside the Keltner channels, but not by much, and probably won't be there for very long. So with that said, what we decided to do is to do a iron condor spread, so selling the low 20 deltas on both sides, buying one strike away. Again, earnings is after December expiration, so we can position size fully for a full return there, and then you can see the break-evens are outside of the bandwidth. The bandwidth's at the lower end of that, so we got some multiple touches near the lower break-even, and we got room to trend higher. If we do break out, we have room to move higher before we hit the break-even up to the upside. So I like that setup. for a pretty decent reward for the amount of risk that we're putting on this particular trade. All right, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.